Christian, yeah, let me just go over. I have a question on scalping gamma. Let me cover this. It's so important to learn this.
So important. It makes trading fun too.
And it does remove stress as well. Scalping gamma is such a productive way to manage your options position. Why is it called scalping gamma? Well, it's just one of the Greeks, right? The Greeks are used to manage an options position. Gamma is one of those Greeks. Gamma and theta are direct opposites. They are absolutely polar opposites. So for anybody who gets confused about what gamma is, but you understand theta, now you understand both. As theta goes down, gamma goes up. Okay? Here's scalping gamma. And I'll just use FCX. Long 10 of the 12 strike calls. Okay, so if you're long 10 of the 12 strike calls, I'm gonna do this along with a spreadsheet as well. I think that's the best way to do this example. Long 10 of the 12 strike stock position, stock equivalent position, is once this position gets in the money, we are long 1,000 shares. Okay? So if the stock, if you're long the 12 strike calls and you bought them, whatever, down here, all you did was you made an agreement that says that if the stock gets above 12, you're long 1,000 shares. So if the 12 strike calls were trading for 40 cents and you bought 10 of them, when the stock was trading at 10, you're long 1,000 shares from 12. If the stock rallies up and gets up to 10.50, 11, 11.25 and expires, you're long 1,000 shares from 12 if you decide that you want to be long 1,000 shares from 12. But why would you want to be long 1,000 shares from 12 if the stock's trading at 11.25? You don't. So you would not exercise. You don't have to do anything. The exchange gives you the benefit of the doubt that if the stock's trading at 11.20, you have zero interest in being long from 12. You have the option, but everyone knows that you don't want to take that option. If or when the stock gets above 12, this is your position. This is the stock price. So when the stock price gets up to 13, you're long 1,000 shares. That's the equivalent of your position. You're still long 10 of the 12 strike calls, but the equivalent, because now you're in the money, you're long 1,000 shares from 12. So when we talk scalping gamma, when it gets to 13 and you decide, you know what, pat myself on the back, I just made a great trade. I'm long 10 of the 12 strike calls. I bought them for 40 cents. Right now they're worth $1.20. People take those off. Well, I don't want you to take those off. Instead of taking off the position, what you can do is you can sell stock. And so maybe you sell 500 shares. If you sell 500 shares, you're still long 10 of the 12 strike calls. Your stock equivalent is going to be long 500. So the trade would sell 500. Now your stock equivalent is 500. You're long 10 of the 12 strike calls, but really you're long, it's like being long 5 of them because this covered your position. This took off half your risk. Sold. Sell 500 shares of the underlying stock here. Sell 500 shares of FCX. Okay? Never touching your options. Why do we do this? Question. Attaboy, Ron, nice. Ron's doing that with DT from his last earnings move.
Nice.
So why do we do this? Well, we take off risk, right? Because if I bought these for 40 cents and I sell 500 shares, on 5 of these, I've locked in $1, the difference between 13 and 12. But watch what you can do. Let's say all of a sudden FCX, the copper company, if they come out with accounting problems and the stock tanks, you're still long 10 of the 12 strike calls. Now what you can do is you buy 500 shares of FCX. And this, my good friends, is scalping Gamma. Because what did you do? If you bought these at 12 and you sold these at 13, you just locked in $500. You're still long 10 of the 12 strike calls that you paid 40 cents for. That's 400. So now you are flat. You don't have a position. You're up $100. You have zero risk left. Okay. Now,
if you're long 10 calls and your net cost was $500, and then you short 500 shares to lock in that 500, you cover your cost, you're a winner. You win if the stock continues to rally. You win if it trades down to zero. No matter what happens, as long as that trade moves, you're in a risk-free, all gains situation. Sometimes it's one big move and sometimes it just oscillates, and you get to do exactly what Jonathan's speaking about. But it's exciting, it's fun. Look at the chart on the screen. If you sell off part of your, or buy back part of your 500 short shares, you can participate on more downside movement and wait for it to happen again. It's rinse and repeat, and it's an awesome way to do it. I love it.